Welcome to the Deep Dive. Today we're digging into one of the most interesting strategic pivots we've seen this quarter. We're talking about Peakstone Realty Trust, ticker PKST, and their Q3 2025 earnings call from November 5th.
Yeah, this one is fascinating because it's a total paradox. If you just glanced at the headline numbers, you'd think it was a disaster.
Yeah, total disaster. But the stock, it rallied.
It soared, up almost 8% the next day. So our goal here is to really cut through that noise, ignore the transition static, and figure out what the market was so excited about.
And that excitement is all about Peakstone's huge, ambitious pivot. They're moving full speed from being this diversified REIT with a lot of struggling office space into a pure play specialist in industrial outdoor storage, or AOS.
And for you listening, iOS is basically mission-critical industrial land. Think trailer parking, equipment storage, fleet depots, things you absolutely need right next to ports and logistics hubs.
Exactly. So the messy numbers we're about to talk about, they're really just a symptom of this massive transformation.
Precisely. You can't dismantle one company while building another without some, ugly-looking financials in the short term.
Okay, so let's get into that noise first. Just how rough were those headline numbers?
They were pretty significant misses. GAAP EPS, for instance, came in at just 9 cents a share.
9 cents. And analysts were expecting what, closer to 60?
Yeah, consensus was around 57 cents, so a huge miss. Now, to be fair, that's way better than the 67-cent loss they posted this time last year, so the direction's right.
Still, that's a big gap. But for a REIT, the really important number is FFO, funds from operations. It's the truer measure of cash flow. How did that look?
Also a miss. Core FFO was 48 cents per share.
And the target there was about 55 cents.
Around that, yeah. So a miss of nearly 13%. And, to round it out, total revenue also came in a little light, 51 million versus a 51.6 consensus.
So misses across the board. EPS, FFO, revenue. Which brings us back to the central question. Why on earth did the stock rally almost 8%?
Because the market looked right through it. Investors understood that this FFO miss wasn't a sign of weakness in the business. It was a mechanical result of the strategy.
What do you mean by mechanical?
Well, they are actively selling off huge chunks of their office portfolio. Those buildings were generating income. When you sell them, that income disappears from your FFO calculation.
Right. So the FFO goes down temporarily, but it's for a good reason.
It's for the best reason. They're deleveraging their balance sheet and focusing on the high-growth iOS assets. The market was buying the strategy, not the quarter-end accounting.
And the CEO, Michael Escalante, he was just laser-focused on that execution story.
Absolutely. The speed of the office sales has been, it's been incredible. In Q3 alone, they sold 8 office properties. That brought in about $247 million.
And they didn't stop there, right?
Not at all. As soon as the quarter ended, they announced another 4 properties sold for about $116 million. They are not wasting any time.
It sounds like they're burning the ships. There is no going back to that old diversified model.
None. And the result is that the last 12 office buildings they own are now officially classified as discontinued operations. They're held for sale.
So what does that mean for the portfolio mix now?
It means they've crossed the threshold. After quarter end, their industrial properties now make up more than 60% of their annual base rent. It's officially an industrial story.
That's a huge milestone. But it's only half the story. The other part is what they're doing with all that cash from the sales. Let's talk about the balance sheet.
This is where they really delivered a home run. Since this whole pivot started, they've reduced total debt by about $450 million.
Wow. And that brings us to the leverage ratio, which is the key risk metric everyone watches.
Right. Their net debt to adjusted EBITDAre is now down to 5.4 times.
Okay, 5.4x. Put that number in context for us. Why is that so important?
Because their stated goal, their long-term target, was to get leverage down to 6.0 times. They didn't just meet the goal, they've already beaten it.
Well, they're still in the middle of the transition.
In the middle of tearing the company apart and rebuilding it. To hit a leverage ratio that's borderline investment grade while doing all of that, it just sends a massive signal of strength and discipline to the market.
It really shows they're building on a solid foundation, and they're not even done paying down debt.
Not even close. They expect another $300 to $350 million from the final office sales, and the plan is to use a huge chunk of that, $250 to $300 million, to pay down even more debt.
Which leaves them with a ton of flexibility to buy more iOS assets when the time is right.
A remarkably clean balance sheet, yeah.
Okay, let's circle back for a second. You mentioned that continuing operations revenue was a miss.
Yeah.
Was any of that a real sign of weakness?
No, and this is a great example of accounting noise. When you reclassify a building as held for sale, its revenue gets moved out of continuing operations and into discontinued operations.
So the money didn't vanish from the company. It just moved to a different line on the income statement that analysts weren't focused on.
Exactly. It was a direct mechanical result of executing the strategy. It had nothing to do with the performance of their core industrial assets.
Got it. So that separates the noise from the reality. If deleveraging is the foundation, then the industrial outdoor storage portfolio is definitely the growth engine. What did we learn about it this quarter?
The quality is just exceptional. Their entire operating iOS portfolio is now 100% leased.
100%.
100%. And that's driven by, just relentless demand from tenants and the fact that you can't really build more of this stuff.
Right. Municipalities just don't want to zone 20 acres of land for truck parking next to a major city.
They don't. The supply is structurally constrained, and that scarcity gives PKST incredible pricing power.
And we saw that pricing power show up in a big way in their leasing spreads. This is where the story gets really compelling.
The numbers are staggering. Their weighted average releasing spreads were 116% on a cash basis.
Let's just pause on that. It means when an old lease ended, the new lease they signed was for more than double the rent.
More than double, on average. I mean, you just don't see triple-digit mark-to-market anywhere else in commercial real estate right now. It's unheard of.
Did they give any specific examples?
They did. They highlighted a deal they did in Norcross, Georgia. They modified a lease and locked in new terms that resulted in cash spreads of 239%.
239%.
And 251% on a GAAP basis. I mean, that one deal is just proof of the explosive value that was sitting dormant on their balance sheet.
And at the same time, they're recycling that capital from the office sales very deliberately.
Very. They bought 3 fully leased iOS properties in Georgia and Florida for about $58 million. And these were high-quality assets, long leases up to 10 years, with built-in rent bumps every year.
So locking in stable, growing cash flow.
That's the playbook. And even with all the portfolio changes, their core same-store cash NOI, that's net operating income, was still up a healthy 3.7% year over year.
That's solid growth. And they're still trimming the portfolio too, right? Not just the office buildings.
Yeah, they sold 3 traditional industrial buildings, so warehouses, not iOS, for about $72 million. They're really focusing the portfolio.
So when you put it all together, the market was clearly willing to overlook the short-term FFO drop because the quality of the new business is so high. But what about the guidance or the lack of it?
That's a great point. PKST explicitly said they are not providing any formal EPS or FFO guidance for the near future.
Which could be a big red flag for some investors, so why didn't the market punish them for it?
Because management was totally upfront about it. They basically said, look, the business mix is changing every single day. Any number we give you now will be unreliable and noisy.
So instead of giving a bad number, they're giving no number.
Exactly. And the market interpreted that as prudent and conservative, not evasive. The message was, trust our execution and we'll give you clean guidance once the dust settles.
And that trust is obviously there. We saw it in the stock price. It went from $13.31 before the call to over $14.30 the next day.
And it's not just the market. We saw analysts like Truist come out right after the call, reiterate their buy rating, and stick with a $19 price target.
So they see even more upside from here. If you're an investor now, what are the next catalysts you're watching for?
It's a 3-step process, really. First, they need to complete the sale of those last 12 office buildings. Get that done.
Step 1.
Step 2 is using that $250 to $300 million in proceeds to do that final big debt paydown that completely de-risks the balance sheet.
Okay.
And step 3 is the big one. Once the portfolio is stable, they'll be able to issue their first clean, reliable guidance. And that's the moment the narrative shifts for good from a transition story to a high-growth REIT. That's the re-rating event everyone is waiting for.
Now let's move to our segment. This is not financial advice. This is purely for educational purposes, a way to think about how you might structure a trade around the events we've just discussed.
Right. And the idea here is to capitalize on that very specific transition gap we've been talking about. Right now, the market is still pricing PKST like a messy turnaround story because of the FFO drag and the lack of guidance.
But we know what's coming next.
We know what's coming. We know leverage is already low at 5.4 times, and it's about to go even lower with that final big debt paydown. We're projecting that's going to happen by the time they report Q1 2026 earnings.
So that debt paydown is the event. It's the moment that removes the last bit of major risk from the story.
It's the final all-clear signal. So the proposition, the tactical trade, is to take a long position in PKST leading into that Q1 2026 earnings report.
You're front-running the good news.
You're betting that management executes on that final piece of the plan. They sell the assets, they pay down the debt, and this is the key. They use that clean slate to issue their first, even if it's conservative, same-store NOI guidance.
You're betting on the announcement of a totally clean, forward-looking growth story.
And the aggressive part of the bet is this. We're betting the market will not wait around. The street won't need to see 2 or 3 quarters of clean results.
They'll re-rate the stock instantly.
Instantly. The second they get that final debt paydown confirmation and that first piece of clean guidance, the valuation gap between a turnaround and a growth REIT could close very, very quickly. You're betting on the power of clarity.
That's a fascinating way to frame it. A conviction trade on management hitting a clear and predictable timeline.
And that wraps up our deep dive on the PKST Q3 2025 earnings call. The key takeaway here is pretty clear. This was a quarter all about execution.
It absolutely was. Strong strategic execution on the office sales, significant deleveraging of the balance sheet. They did exactly what they said they were going to do.
And at the same time, the quality of that new IOS portfolio is just undeniable. We saw it in the operational numbers, especially those incredible 116% releasing spreads.
And that operational strength is what gave the market confidence to look right past the messy short-term FFO and EPS numbers. The transformation is almost complete. The question for you, the listener, is whether you price the company based on today's noisy transitional numbers or on its imminent status as a clean, debt-light, high-growth specialist.
That's the whole game right there. Keep your eyes on that final debt paydown and the first hint of guidance. That's the starting gun.
Thanks for joining us for this deep dive. We hope this helped you get behind the headlines on this really fascinating pivot in the REIT world.